Okay, everyone, welcome. I'm here from cloudy London, and today we're going to be talking about media for equity. Media for equity, as many of you, if not all of you, already know, the practice of taking equity in a startup in return for advertising space, be it on TV, radio, print, outdoor, instead of simply financial funding. We're going to be going through some of the basics and some of the not so basics. And if there's anything you'd like to ask the panel, please type your questions in the Q&A section. I can't promise we'll get on to everyone, but I can promise we'll try. Okay, so now to introduce the panel. First up, we have Vinay Solanki. He is head of the Media for Equity arm of Channel 4, the UK TV channel. Tell us a bit about that, Vinay.
Okay, so Channel 4 is a publicly owned media network with broadcast TV assets through traditional TV networks and video on demand. It reaches 90% of the UK, so it's mainstream channel, so it's entertainment, lifestyle, documentaries, news, drama, etc. And it's focused on the UK market. I run their venture arm, and so we swap equity, which is the reach into 40 to 50 million people, and it can be segmented in a number of ways. We provide millions of pounds of a deal value of media in return for shares in companies. We've got about $100 million under management right now, over 30 assets, and it's taken about 8 years to build, and we're growing quite nicely. Our AUM has gone up 200% in the last 4 years, for example. We're stage agnostic, but we don't really do seed, and we're like a vanilla equity investor. So we come in alongside other investors. We take the same terms more or use those as reference. Sometimes we set the terms if they're not appropriate or there's a time period, and then there's nothing really strange or funny with the media value component. The media value has a clear cash value and it's benchmarked against those values. So there's no real discounting on the media that we provide. We're a capital provider, really. And I've got to 30 assets, but I think I'll get to 50 assets and more assets under management over time, because I think we've got something quite unique. So, yeah.
Okay, great. And over in the US, we have Arjun Kapoor, who heads Forecast Labs, which is part of the Comcast Mass Media Group. And you have a bit of a different outlook in terms of how you actually do media for equity, isn't that right?
That's right. So, hi everyone, I'm Arjun Kapoor. So we are part of Comcast NBC Universal, and our twist on media for equity is that we don't exchange market price media value for equity. What we do is we exchange a value of customer or revenue that is driven to a company in exchange for equity, and that customer revenue is driven at the back by TV media. So in our situation, if we end up running $1 million worth of media for a company and hypothetically it yields 0 in customers, we don't actually get paid anything. So it's all based on the amount of customers we drive and a preset customer acquisition cost for TV that is paid in equity, preferred equity, if you will. And as that, we basically earn our ownership over time as we drive customers and revenue to the business. So it's still backed by media, but it's performance oriented, and it has some sort of shared incentives with the founders. And we have about, say at this point, we've been around for 5 years. And we have about 16 or so portfolio companies. We do about 6 to 8 investments a year right now. And we largely focus on consumer businesses and consumer businesses that are looking to scale faster in a more mass media channel, want to diversify outside of digital, and are looking for a more measured sort of analysis on the impact of media on the business. So that's a little bit.
Okay, great. And but of course, you don't really need to be your like a media company with your own unit. You can also work with someone like Nico Vescher from German Media Pool. Give us an idea of how you approach it, because it is a little bit different, isn't it, Nico?
Sure. Thank you, Rob. First of all, let me thank you also for being part of this panel. Very exciting to talk about media for equity. I'm the founder of German Media Pool. We are an independent media for equity fund. That means we are not owned by any media group. We're essentially owned by ourselves and some angel investors, which invested at the very beginning of our journey about 10 years ago. But we offer ourselves as a fund service to more than 40 media companies in Germany. These are companies, television, out of home, radio, and print. And we invest this media from our media companies into startups in Germany, and we've invested in about 40 startups as well. So we've invested in some fantastic consumer-facing brands like About You, which is a fashion platform, Grover, which is a fintech and tech rental service, another fintech called Clark, etc. So some really exciting companies as well. So you're right. We are actually almost like an intermediary between the media industry on the one side and the startups on the other side. And we provide them with a full end-to-end investment service so that they can provide their media to these startups.
Okay, excellent. And finally, there are obviously two sides to this kind of interaction. And Leif Abraham is the co-founder and co-CEO of Public. You may know them. They're essentially a public online brokerage. And you know a few people on the panel already, don't you, Leif?
Yeah, so we have done some deals like that, and so we work with Arjun in New York, and then we also have a deal with, for example, iHeart, which is podcast and radio network in the US, and then I know the other two gentlemen as well, as we've explored some more international efforts in the past, but yeah.
So because you've taken a Media for Equity, haven't you?
Yeah, exactly. That's what I meant. Yeah. So like, so we work with Forecast Lab and Arjun, and we also work with iHeart and so on in the US.
Okay, great. Well, in that case, Leif, I guess one thing we wanted to kind of get clear is, since you are a startup, give us an idea of the benefits of a startup taking Media for Equity instead of, or in addition to, venture funding.
So generally speaking, obviously, your equity is just another currency, just like the cash you have in the bank. And so as a startup, right, you will think about how to deploy whatever resources you have. And I will just put your equity as part of that as well, right? And for us, that has been on the one side these media of equity deals in the past, but on the other side also, for example, you might have other partnerships where you also want to use equity to kind of just like create some more like incentive alignment like with that partner and so on. And so I would just see it as like, hey, it's just another currency. And then the question becomes a little bit like, how and when you use that currency, right? When is the cash on your balance sheet better to be used versus some equity? And that becomes a little bit also just a question of where you are in your cycle and so on, right? So I would personally argue that it's also like likely, you want to be more of a growth stage company. You want to be someone who is, already deploying serious media dollars. And so, I would always put it as like, if you spend less than like $1 million a month on just general paid media, you would likely not necessarily do a deal like this, because also most of the media for equity deals, as you see in this panel here, are more tied to traditional media, right? TV, out of home, radio, et cetera, et cetera. What just happens with that type of media is that the first beneficial layer is in most cases awareness. And so you want to kind of layer that with other performance marketing efforts as well. And so it becomes really a question of like, using it in your media mix and so on. And then I think it's a good model for especially startups to just dip your toes into like these types of, media offerings, because usually a startup doesn't necessarily, gets funded and starts buying a bunch of TV ads immediately. That usually doesn't happen. And so it's also just like a good way to kind of get some exposure and like, dip your toes into it and so on. But yeah.
Okay, great. And Vinay, like obviously kind of you work with like a blend of startups like think a lot of the other kind of people, like why should, like, say, a startup take media for equity instead of simply taking equity funding and then spending it on advertising?
I don't think it's really either or, it's and. I think the US ecosystem is a bit different, but even we've done deals out in the US too. In the European or UK ecosystem, the capital pools available still means that companies at any stage, growth stage or even earlier stage, have to make difficult choices of where to allocate their money. I think, a third of all capital or 30 to 50% of all capital in a consumer facing company is spent on marketing. That's investor money being put into growth activities, unless you're very lucky, of course, and you can grow without those sorts of significant investments. So really the choices you have there are, do you stay with your chest of money from the investor, or do you want to invest potentially in other channels? Things like TV are super, super interesting. They help build and elevate your digital channels, because the digital channels might be very good at getting that, 1% or 2% or 4% of people in market at any given time. But people need the spark and inspiration to start their journey. And if you're solving, many companies are solving problems where people already have existing services and trusted supply arrangements. They might have better solutions, but those stories need to be communicated. The digital channels are noisy, and sometimes they lose efficacy. So really, we're looking for, come back to your war chest. You've got your investor money, and they might take care of your digital channels. You might have phenomenal SEO and digital, but really what you're looking to do is try and supplement these companies. And you can find these deals at times when maybe some of those strategies are beginning to mature or not work.
Okay. And Arjun, obviously kind of you also are looking at this from, I guess, the perspective of like a kind of media company. You have quite a diverse portfolio. Can you give us an idea of why it makes sense? Like if maybe you've gone beyond digital marketing, what can you get from this kind of arrangement if you are a startup?
Sure. So in our case, we actually are stage agnostic, and we have done pre-launch businesses as well, where the first dollar they spent on marketing ended up being TV. And we've seen, obviously, in our universe, because TV's at this point with technology very well trackable, and I'm not just talking connected TV or streaming, it's also linear, that we see transactions come through from TV, if you will. And we call that stage more transactional brand building, in a place where you are building the brand. Any customer that touches your business is a customer touch point that is building your brand, whether they're buying or not buying by the end of the day. So at that point, if you're focused more on transactions, and that is a transactional brand building, but it's still building the brand. And it's very important. So you can start at any phase, but I would double click on what Leif said. Once you achieve a certain amount of media spend in general, and call it the surround sound with digital coverage, the efficacy of all channels does go up when they all work in concert. So what we have seen is you can start with just TV, you can start with just digital, but when you do it all together, it just propels everything. And that can happen at any stage, and it just depends on what the need for the business is. And in terms of what Vinay was talking about, when you should use media for equity, at the end of the day, equity is equity. You can sell equity for cash and then deploy that cash to buy media, or you can keep the cash for other non-marketing expenses or reduce your marketing expenses and sell additional equity to do the media. At the end of the day, it's all capital equivalent, depending on how you use it. So it's not that, hey, I can raise capital, I can deploy just use my cash, why should I do media for equity? Well, it's because you are now preserving the capital that has multiple uses, right? Because the cash you have, you can use for multiple things. But if you end up using for media, and you can do a media for equity exchange, you can do a media for or equity for HR exchange. You can do a equity for technology exchange, right? You can do it for media. So preserve your capital in that situation to deploy it to hire more people, grow the business, invest in the technology, and then your capital actually goes much farther than just carving a part of it out and using it for media, which you'll have to anyways. And at least in the US, the data shows about 50% of all capital over time, over the last 10 years or so, in consumer businesses gets deployed in marketing. Now, at every stage, it's different, but that's a lot of money. And if you can preserve some of that capital, we're doing deals a different way. That's just supposed to be expected to be at this point part of your investor mix, just like you're supposed to have CVCs in your mix, not just institutional investors. You're supposed to have a diverse group of investors. Media for Equity is one of those diverse group of investors on your cap table.
Okay, and Nico, maybe give us an idea in that case of what kind of startups does this model work for in terms of, I guess, what kind of industry and how far along are they?
Sure. So, I mean, first of all, it's mostly consumer-facing startups that would be interested in a media for equity offering, because most of the marketing channels that we have are for consumers. There are some startups that are more on the kind of edge to B2B. So, for example, they would be targeting freelancers or people who don't quite fit into the corporate enterprise client set, but also don't quite fit into the consumer area, and those we can also target with some of our mainstream media channels that we have. But in general, it's consumer focused companies, and I would say it's companies that are accelerating along their path of growth. So they've done their first products out there. They know how it works, know how to generate conversions, but they want to accelerate their growth. So I think it's mostly the medium stage, maybe a Series A, that we would be targeting with media for equity. And it's all kinds of consumer-facing industries. So it could be fintech, it can be mobility, it can be health. We've invested in fashion, we've invested in age tech, which are specific services for older people. So there's a whole range of consumer-facing industries that this can apply to. And Robert, there was one more small thing I wanted to say about the benefits of media for a startup. And we spoke a lot about branding and we spoke a lot about traction. But what we didn't mention is that many of these media also provide a startup with the ability to do storytelling. Why are they different? What kind of new product category is this? So for example, we have a insurtech that we've invested in called Clark, but they don't offer a single insurance. They offer like a wallet of insurances. So it's like more like an agent. It's a robo-advisor. People don't know that that necessarily exists out there. So we also have to inform people, hey, there's a new category that you could really benefit from. So it's the storytelling aspects also really a very, very, I think, beneficial value of media for equity.
Yeah, and I think one of the other kind of things is, Vinay, like you mentioned earlier on that, you know, even though you are UK based, you also kind of invest out like in companies that are outside, I guess, like the UK, even though really the advertising space you're offering is just in the UK. Give us an idea of why this might work, maybe for, say, a good way of entering a new market.
Yeah, it's a great question. We've done a few deals like this. So look, ultimately, international expansion requires capital, right? So then you may, but in the instances where we've done deals of growth expansion, often they're platforms, technology's built, the technology's perfected. The choices you have are, you know, you need a country manager, maybe some marketing people, PR people, maybe some ops people, but you're going to have a budget, and then you need to allocate like, you know, a spend of you know, cash spend on marketing. So of course, like the idea of trading your equity instead of cash and preserving capital dramatically reduces your market entry launch costs. So I think it's something that can be at the right stage of growth, you know, actually the catalyst to enter a new market. And I expect, like in the, you know, in the current market, we'll, you know, people here, you know, I'm talking about Arjun, Nico, we'll be working on deals together. I know, I have no doubt about this. So
Okay, great. And Life, like from a startup's point of view, at what point, like, did you kind of take media for equity, and like, how did you find it actually helped you in practice?
So yeah, first of all, like I said, I think you have to be growth stage. You have to be the point where you're actually deploying real dollars and you're, you found a product market fit, you're now out and just trying to acquire customers. And you're also just spending enough already that you can kind of, layer it in. Because again, like most of these traditional media channels have a little bit of an awareness aspect to it. And so, you shouldn't just purely rely on that purely for acquisition, right? The other thing also I think is that the actual deal matters, right? So yes, equity is a different currency, but if you use cash or equity, it's a little bit the question of first, when does it happen? And so I would argue that most media for equity deals for startups, should likely more happen between funding rounds than necessarily, directly in funding rounds. I think the only reason why someone would add it directly to a funding round would be, if there's, for example, let's say they raise $50 million, for lack of a better example, and they're like just getting over to close to $50 million, and then they can, add another media component on top of it. That's an opportunity for them, great. But usually, you would just like raise more cash in that moment and then deploy that cash or whatever, versus having the commitment that you're also having if you do a media for equity deal. And so I think it's actually happened, like a better moment is actually in between funding rounds. Hope no one's going to kill me here on this call for saying that, but saying Renee looking at me. And I think the other part of it is really just like, what is the component in that deal that makes it a much better deal for you than just spending cash? And what Arjun and Forecast Labs do really well is that it is literally a different model, right? Like it is performance based, and like the way it's like it's structured is also just like a different product than me just going to a media agency and buying media, and that is a product I wouldn't have access to otherwise, other than going through Arjun, and so that is like a little bit of like a special case, and then if it's not like a specific special product you couldn't get access to otherwise, then I think it is becoming a piece of, how is that deal better for you? Is it because you're getting extra discounts on media? Is it because you're getting access to something you wouldn't get access to otherwise? Is it because you're getting free support in your booking and targeting and whatnot, and free support in creative development, et cetera, et cetera. But I think it becomes a little bit of a question of like, if you swap your equity there, then what's special in that deal, right? And the other piece is also then like, hey, maybe just like the valuation that gets kicked in when you do the deal is a different one than the one you had in the last round, et cetera, et cetera. And so you have like a little bit of like an in-between mode where, hey, I want to extend my runway a little bit, or I want to press the pedal a little harder on acquisition right now, but I don't want to raise a proper round right now because I want to get that extra boost for that next round, and that's why I think like it can be a good tool in between rounds, because it's kind of like a little bit of like a strategic mode you can have without having to either use the cash out of the balance sheet or having the pressure to now suddenly like raise some in between node or something before you hit your milestones for the next proper series, whatever.
And I think that is something we're going to briefly touch on later on, but in between there, like Arjun, I thought it was really interesting what Life was saying in terms of you may not be just a direct media for equity investor. There is actually kind of some more technical stuff involved in what you can actually provide the startups that you work with.
Yeah, so in our case, we do three particular things. Media is one of them. So we help the companies create TV commercials that are designed to elicit a response and what we call brand response. They're polished branded commercials that have all the science that will drive a customer to convert or have a call to action, if you will. Then obviously it's the media component, which we talk about, where we try to find the relevant customers. And because we're the ones potentially at loss if we put some media out there where it wasn't the right audience and nobody converts, we're the ones then hands-on running the media and then reducing the amount of media that is not working for the company and then scaling up the media that does. So that becomes a lifetime optimization on our side, because we have to consistently show performance, because with performance and outcomes is the only way we get our equity ownership. And then we also help the companies with the conversion funnels and talking about and helping them with structuring A/B tests and how the actual person who lands on the website or the app can get converted, how to do that better, et cetera, et cetera. And we have experts that will do audits and help the company on that part. So we try to touch on the messaging, the media, and the funnel in order to really increase the number of customers a company drives. And by the end of the day, in our model, it's all outcomes based, right? So we know a customer that we've driven, we know what lifetime value that customer is going to drive and what revenue that customer is going to drive. We know what enterprise value increase will happen for the business if the said number of customers are actually paying customers are actually driven to the business. In which case we can actually show the entire value driven or the impact of our model to the existing cap table and the investors, and they can see us being one of the few that on the cap table that are actually driving the revenue, and it's a measured exchange from that standpoint. So we tend to not have any pushback ever from the existing investor base, questioning the validity of media for equity exchange in our model, just because of that exchange. And then the last unique aspect is we're not doing a finite media for equity exchange. Like I said, it's performance and customer oriented. So all our portfolio companies like Public have an at-will walk-away clause. At any point, they can decide, I'm out of this agreement today. They can walk away. Any amount of allocation we have that is still outstanding that we haven't earned, that falls back to the company and the cap table. They can walk away at any point within 24 hours notice. That's because every day we wake up, we have to really show our impact on the business. So the model's slightly different, but by the end of the day, it's still powered by media. The background is still media that is valuable and working and works for a business to grow.
Okay, and I was actually going to come to you next, Vinay, but obviously, like when we look at this model, it's not a it's not a normal corporate venturing model. There's no real strategic kind of benefit for the business. Well, that being kind of the case, give us an idea of what it's like kind of working with a kind of a parent company, a media company, where you kind of have to convince them for the need for this, where there isn't necessarily a strategic component.
So look, sometimes one of the questions I get is, which one is your favorite asset in the portfolio? And it's a bit like asking someone who's had a lot of children, Elon Musk, to say which one is your favorite child, right? And I don't think individually, I think we make the decisions, but ultimately I think the portfolio is strategic because it builds capital value, which is diversified outside of core income streams. And so I think ultimately the story I set out to the companies to say, here's a capital efficient way to build an asset base, diversified, and the numbers are very, very interesting, let's say, and then you repeat that story again and again, and I think that's the journey I've been on. But also the numbers sort of after a time, the portfolio settles down. I think the first milestone is get to a sensible set of investments that feel like they're behaving in a diversified way. And of course, when you get past 20 or 25, as per standard portfolio theory, you're in a good place in theory. I think it's always a journey, and I think this is very common with other corporate venture units, to explain the timescales of the venture life cycle and the momentum in the market and the noise in the market versus the windows of opportunity you get to explain this stuff. And that's a core part of the job, and it's an important part of the job, because ultimately you need to articulate what this is to people who are not working in this day to day. But that's very common across, I think, all corporate venture units.
Okay, and Nico, you had your hand raised?
Yeah, I saw now that Vinay was raising the hand quite effectively, so I thought I was my try. There, Robert, if I may, I saw an interesting question in the chat, which
I was
was
actually,
kind of
I was going to ask you either next. Please go for it.
It swings the spotlight away from the startups and the value that it brings to the startups to the media organizations. And we are at arm's length away from the media organizations, but the question was something like along the lines of this: is that where are the Media for Equity units placed within the media corporation? Do they report to sales? Do they report to the CFO function? Do they report to the central board or the CEO? And in our experience, we also have contact points, obviously, at our media organizations. And very oftentimes, they are close to the CFO or to the strategic heads of our media partners. And those are the ones, obviously, the sales teams are very much focused on monetization and bringing in the revenues. Whereas the CFO function or the strategic function are thinking maybe beyond that and saying, okay, how can I monetize my inventory even further with an innovative investment model to bring me returns in the future? And one of the other benefits, I think, from the media partner perspective is that they are starting to develop through Media for Equity relationships with future clients. So startups might start with Media for Equity and then later migrate to become regular clients of the media group. So it's a great way of bringing new clients into the fold and to start to have relationships with them and to provide them with their services. So I'd be also very curious, Vinay and Arjun, where your units are actually placed within the corporation. Is it more within the CFO or the sales groups? But with our experience, it's the CFO and the strategy people that we work with.
Yeah, because Arjun, like you're part of like an organization where there is also Comcast Ventures. Like you're kind of working, I guess, under the umbrella with a traditional CVC unit. Give us an idea of how that kind of works within the organization.
Yeah, so we're sister companies. We're basically in the same office. We're one extended team, if you will. Our focuses are and method tends to be different, right? And to Nico's point, yeah, in the organization, you would sort of be either within the finance or the strategic development or corporate development function, typically. But it has to be close to both, because when you're doing investments, it's not just about evaluating an investment and seeing what might be good 10 years from now, 7 years from now, 5 years from now. It's also about managing equity, markups, managing the accounting of that portfolio, et cetera, et cetera. So a big finance, a heavy finance sort of view is also required to manage an investment portfolio, if you will, write-downs of investments and all sorts of things that happen. So it's not just the investment professionals, but the finance accounting folks that are very important to it, and the strategic view, depending on why the company is doing it. Now, you know, the conversation also was about the sales folks. At the end of the day, it doesn't live in sales because, or most times at least, I haven't seen a situation where it's lived in sales. It's largely because their focus is fiscal year focus, and the revenue they're trying to drive is fiscal year revenue. But when you take a Series A investment or seed investment, even a B investment, it's not necessarily converting into a return for 5-7 years on average. That's a different time horizon, so that needs a little bit of a strategic view and you know, some a patient financial view, if you will. So therefore, it doesn't generally sit in that function, even though you have to make sure that you're not stepping on toes and giving media that otherwise will drive sales that year either, which it does. But then you have to, you know, you have to work out a good carve out with the organization, which is a delicate balance for many media companies.
And Vinay, like just to follow on from that, obviously Channel 4 Ventures is kind of positioned a little bit differently. Give us an idea of where you sit in the organization.
Well, I sit in sales actually, but I agree completely with Arjun. Really, the governance sits probably around 3 execs. So there's CFO, COO, and the sales function. Ultimately, there's an awkward fit in the size of organization we are. We're not quite big enough to have a corporate development department, so then we've had to kind of sit somewhere. I think there's an opportunity where it might evolve a bit over time, but I think that there's no real perfect home for it. I think the execs who are across it, who are across many other core functions, are spending less than 5% of their time on this activity, probably even less. So and it's kind of our job to keep that kind of council of execs up to speed, buff on individual investments, key approvals, and portfolio performance. So that, we're doing that realistically, and deep dive on the portfolio. We're doing that twice a year.
Okay,
and we're doing 10 deals a year, something like that. So the approvals are coming in. And we are looking at ways to streamline, so we don't, for follow-ons, for example, we can do an email approval, with a paper attached, etc. And hopefully people can kind of push things through. We can get things done fairly quickly, let's say. So with that kind of council across that, little council of people who approve things.
Okay, and coming back to you quickly, Nico, obviously what German Media Pool does is different. You kind of work with a portfolio of, I guess, established media companies, but also at the same time, you're kind of working with startups. Give us an idea of why, if you're a media company, it might work better to do this than, say, to launch your own thing, like, say, Comcast or Channel 4.
Well, I think a media group obviously needs to make their own choice. So the choice is between, if you want to launch it yourself, you have to build up your own team, and there is a lot of work that has to happen to do this in a proper way. So not just do you have to source the companies, so you have to have an excellent connection to venture capital industry, excellent connection to the startup landscape. You have to be able to source these deals. You have to be able to speak their language. You also have to manage the deals once they're invested, and Vinay and Arjun know how hard that is, to keep a tab on the startup, keep being involved, make sure that the media campaign is also properly delivered. But then also, even exiting a company requires a lot of management effort. Sometimes the exits don't happen by themselves. Sometimes you have to work with secondary funds to do an exit. You can't, we're trying to monetize in a continuous way and not wait for years and years for all of our investments to pay off. So there's a lot of activity that has to be done. And so some media groups are saying, that's not our core business. We would like German Media Pool to do this for us. And that's why we offer this as a service. But I think at the end, every media group can decide whether they do it themselves or run it via a fund like us. I think another interesting thing is that there are so many models. As you see even in this panel, there's so many different ways of doing media for equity. There is an initiative called Media for Growth, which is a global platform. They're trying to actually standardize around media for equity and have media groups communicate with each other, startups communicate with each other, and everybody to kind of exchange information about how this all works. So I think in the next couple of years, there'll be a lot more standardization in how we do these deals. And I think that's welcome, because right now we're all kind of inventing ourselves, which is great and exciting. But the standardization will hopefully bring this out to even more startups and even more media groups.
And Leif, just to come back to you, obviously we've been taught, there are a lot of kind of different models of this, and there are so many different kinds of media companies. And then you have someone like, say, German Media Pool, where it's actually a fund. If you're a startup and you're kind of looking to take media for equity, what are the main things you're looking for in a potential partner?
I mean, first it starts with, is the media and the equity even interesting and doesn't fit into my media mix? That's, I think, the very first one, right? Does it even make strategic sense for me to do this? Then I think second to that is, how attractive the deal is, to be frank, right? And that comes down to pure negotiations around pricing of valuations and, PPS and whatnot. There can also be other terms around it, there's things where it's, structured as a note, for example, and stuff like that, and then there's different ways on how to handle that, and when does it actually convert, and what are the conversion moments, etc., etc. And that can maybe be interesting suddenly, so where you're a little bit more control of when that equity is technically paid and stuff like that. And so there's a lot of just like deal structure things that can make it attractive, you know, other than just the pure media value. And that's again, you know, where the currency of equity is just like you can be more creative there than you can be with cash in most cases. And then I think the other piece is really just like model, right? Like, you know, back to like what Forecast offers is quite unique, you know, and it's again like it's a product you can't find anywhere else really, or you can't get access to otherwise. And that is another piece of, you know, what can make it attractive. Than just, you know, sitting on media credit somewhere, for example, you know. And then obviously, you know, media credits can have a certain value. There's maybe certain discounts you can access, et cetera, et cetera, et cetera. I think that's kind of what it comes down to. The other thing is also is that, you know, traditional media in most cases is just like, it needs sometimes more hands-on, I won't call it hands-on management from a day-to-day, but like, you know, there can be some quirks to it, right? Like, you know, from a sense of that, you know, attribution can be harder, you know. It can be that, you know, there's certain media where maybe attribution is literally impossible, you know, and, you know, and so on. Like if you run, you know, a bunch of like, anyone who's ever done podcast ads, for example, you know, knows what a pain it can be to try to get some attribution done well. And so on. And so even just like the question of like the media is one thing, but like what support you get around that media, you know, and just like pure knowledge sharing around it, you know, like, you know, Arjun and I have been, you know, nerding out about creative for 3 years now, pretty much, right? And there's a lot of kind of learnings there and so on that might not even be natural to someone who has spent a lot of time in performance marketing, you know? And so, you know, an ad you've made for YouTube might do horrible on TV and vice versa, you know? It's not just having a video and putting it live. And so there's a bunch of stuff like that as well that can be really valuable. That you would usually maybe need to pay extra for, right? So even if you would cash for your TV ads, you know, maybe you would need to add another, you know, called another 15-20% on top of that, just to consider like, you know, having proper headcount on it, having proper advice on it and so on to do it well, you know, and that could be, you know, like a discount in disguise in some way as well, you know, as part of the deal and stuff. So.
Okay, and just briefly to follow on for something you said, you mentioned deal structure. Like, can you give us an idea of what might be an inviting deal structure compared to what might not be?
It completely depends on where you are as a company, you know. Number one is obviously just like straightforward valuation, you know. There is, you know, it also depends on obviously like, you know, how folks truly value their media, you know, internally. We all know, like we've all booked traditional media before on like 50 to 70% discounts. And so like, there's a wide range, you know, sometimes on like what list price is and what is not and so on, which then also that could trickle into your general negotiation as well, which falls into, you know, what does the media value convert at, like which PPS does it truly convert at and stuff, you know, and, you know, the credits you receive, like, you know, how are they truly being deployed, et cetera, et cetera. So the other thing is just like pure legal structures, right? Is it a warrant? Is it a note? Is it part of a round? Is it in between rounds? If it's in between rounds, you know, and you've grown a bunch, what does it do on price? And so on. And so there's a lot of stuff there that, you know, can make a difference. And like, you know, notes can be interesting because conversion might happen in the future. And so, you know, you won't see the dilution yet, or you maybe don't know what the price will be until it actually converts, you know. And then the question of like, what kind of conversion events do you have? Like, have you built in? You know, those are things that can be negotiated and so on. That maybe gives the company some control over like, oh, it might not convert directly at the next round. You know, who knows what the price will be, but it will convert within this time frame at these criteria if this and this happens. You know. Et cetera, et cetera. And so there's a lot of like nuances in just like the actual deal making and the structure of how the deal is constructed, you know, that can add to the attractiveness, you know, of doing an equity deal versus just paying cash.
Okay, and Nico, we've had a couple of questions in the chat about how you actually kind of do accounting for this kind of thing versus an equity investment. I actually wanted to ask you this because I know you guys also have a follow-on fund that actually does make kind of cash investments in addition to like the initial kind of like the media for equity stuff. So can you give us an idea of how the accounting, well, briefly how the accounting works, and I guess like how you kind of evaluate the like equity investment versus a media for equity deal when you're actually going to look at what's a good investment?
Yeah. I mean, the highlights work generally like this. So when we invest media, we provide the media at either the market price or slightly below the market price. So it would be some kind of advantage that the startup has in taking this media. But we provide it to the startup at the valuation of the company in that round. So we can provide it as a convertible loan note, but we can also enter into a round, an investment round, and usually you'll have a cash lead investor that sets the valuation, and then we provide the media in for the market value of that media and receive shares for that. What then happens, however, is because there's media being provided, there's also an invoice that gets sent. The principal amount of the invoice does not have to get paid. In Europe, a VAT has to get paid, but the company gets reimbursed for that VAT. On the media side, the media group will in general account for that revenue that it has provided for the startup as revenue for that year. So it will have to pay taxes on that revenue that it provides the startup with. So it's not entirely a free deal for the media group. They have to calculate that they will have to pay taxes at year end for the media that they have provided. And then, of course, if there's an exit, there's a capital gains associated with that, which is usually taxed at a less higher rate than the corporate profits that are taxed through the revenue. So in general, that's how it works. From a startup perspective, what's important to know is that there are invoices. Principal amount does not have to get paid. You do have to get VAT. You get that back. But in general, it really works like an investment. It's just an investment in kind instead of cash.
Okay, and Vinay, moving back to you, I think we're going to kind of start summing up in like a little bit, but I wanted to actually ask you and Arjun, like, what does actually a media company need to have in place in order to succeed with this model?
I think firstly you need to have relevant media at scale. I think the smaller the reach is, I think it starts becoming a challenge. So firstly, you know, it's great for us because we have broadcast media and we have a phenomenal reach. And that's a starting point. And then the second component is really a specialist team that can do all the bits that we covered: the sourcing, the analysis, the management, the skill of actually sometimes selling and negotiating the deals, the knowledge of the terms, notes and convertibles are all part of the way in which you get these deals. And then the third component is actually vision or strategy. Probably like you need to have a medium to long-term strategy. You can't just do one or two deals out of the corporate development department, in my view, because you're left probably hanging on, you know, you've got to have a commitment to get to standard deviation portfolio theory, 20, 30, 50 assets. And then you're probably in a good place. And that takes quite some time. I think it's, you know, we've settled on a team at Channel 4 Ventures over several years, but like, you know, it takes a little bit of time to build that team. It's, you know, it's in terms of like the market for media investing is very, very, very nuanced. Relative to kind of vanilla cash investing, I'd say, I think it's quite a skillful consultative sales process where you have to really understand the pain points of the company, and it requires, I think, quite a lot of skill. And so the specialist team become a very important component of that. But then, you know, what you built a specialist team, the job's super, super fun. There's no question about that.
Okay.
Yeah, I think from our perspective, you know, you have to for a moment almost park the idea aside that you're doing media for equity and think of it as you're building a venture group, right? And that requires experts that think like investors, can have a good network, can source the deals. And just because a company might be relevant for TV advertising doesn't mean they would make good investment. just because they would make a good investment doesn't mean the price at which you're entering that investment and the terms that you're entering those investment in are actually worthwhile making the investment. So understanding that by the end of the day, you are first investors, you are sourcing and making deals, you are evaluating and doing diligence on those businesses. Many of those businesses may be in regulated markets. So having a specialist investor view and a group that is able to do that, whether it's thesis-oriented investing or sector-oriented or strategic, however you think about it, at the end of the day, you're investing. So you have to have an investor mindset. You have to have a portfolio construction mindset. You can't build all companies on the same sector when you're doing media for equity, because at the end of the day, you know, there are many funds that exist that will only do seed or only do A, but in media for equity, you try to be more diverse. You have to have a stage construction on your portfolio, not just a sector construction. You have to think about now, you know, cash buys the same equity, you know, but at the end of the day, you have multiple audiences and audience segments when it comes to media. So you can do multiple different sectors based on the multiple different audiences you have that may respond to the media, that may be relevant to the company. So you are generally a lot more diverse in your sector strategy and your audience strategy. And then by the end of the day, the media is a cash alternative asset on your balance sheet. And that's what you're utilizing as opposed to cash. But you have to first surround yourself by folks and mindsets that are more investing. And then your tool ends up becoming a cash alternative tool, is how you would build a more successful, whether it's an independent fund or a group within. But if you don't build that group that is investor mindset, then you have a lot of pitfalls and blind sides that'll come into your investing work.
Okay, and lastly, kind of, I guess, to sum up in that case, this is really still a relatively new model. It's been going, I think, 20 years, and it isn't something that's really even been that widespread until I think a bit more recently. So I really wanted to go around the panel and like ask everyone, what do you think Media for Equity really needs to do to actually reach that next stage and actually kind of advance to the next level? And I'll start with you, Nico, just because I think you've been at this maybe longer than anyone else in the panel.
I think one ingredient I've already alluded to, which is more awareness of media for equity amongst startups, especially consumer-facing startups, and more awareness amongst media groups that this is something that can also help them a lot, not just to get revenue and additional monetization for their inventory, but also to forge some new contacts to future clients. So in general, just awareness would be really, really important, because I think this is a great way of having startups accelerate their growth. It works, as we've proven. All the people on the call have proven that with their respective funds. So, and it's exciting. Like Vinay said, it's a very, very fun job. And I think it's also fun for all of our portfolio companies and our media groups who are participating in this.
And Leif, like, I mean, you've kind of taken, I guess, Media for Equity from Forecast, and I know you've like been in talks with other people. Can you give us an idea of like, from your, I guess, point of view, like, where does it really need to go to really reach that next level for you as a startup?
Better attribution everywhere. That's really the biggest pain point in traditional media, I would say. With streaming, you know, coming in more and more everywhere, like that gets better by far, you know, versus like linear television and, you know, radio and whatnot. But there is a clear, you know, if you're a growth marketing manager in a technology company right now, like you're used to, you know, having all the bells and whistles and the dials and like your data here and there. I'm not saying that attribution is great in these days now, but still, if you compare that to traditional media, there's still a big gap, you know. And you know, if you're someone who handles data as part of your job, you obviously like you know, I won't say call it accuracy, but like you kind of, you know, yeah, like it if it's like very precise, and you know, you want to just close your eyes and rely on it. And you know, marketing managers have to kind of like a little bit adjust you know, when you deal with traditional media. And you know, and therefore, you know, it sometimes takes a little bit more experience and gut to make decisions, not just look at a dashboard somewhere.
And Arjun, like you raised your hand. I know you have a strong opinion on this.
Yeah, so pre-venture, I was an operator in New York Tech startup universe. So I'm going to put that hat on for a moment. I think it's very important for media companies to understand the psychology and mindset of a startup entrepreneur. At the end of the day, you're not thinking, because you're coming to companies that generally are not ready for television or aren't thinking it yet when you make the investment. And so you're bringing in an earlier grouping onto TV generally when you do this. The folks aren't thinking, I have a marketing budget, how do I use it? Or I have an allocation of equity, how do I use it? At the end of the day, for somebody like Life, if whether he gives up 1, 2, 3, 4, 5% ownership in his business, he could do that to hire product people. He could hire marketing people. He could hire HR people. He could hire anybody else. He could acquire another company with the cash. Cash is fungible for startups. It comes from the same bank account. There aren't really any budgets that you have to use or lose. So at the end of the day, performance of the media and how it did and what return it is creating for you, and could I create that return by hiring 3 other engineers alternatively, is usually a decision rubric founders are using. Like, what is the alternative I get for this? So measurement is becoming more and more important in a capital sort of preservation environment, because you need to know it's doing something positive for your business and how much positive, and can you get better returns, whether it's for your cash or equity elsewhere. So to be good stewards of capital and invest that capital on behalf of your own investors in your business, you have to know whether you're getting $2 here and $2.50 here, or 1 here and 3 here. And it's not just the attribution because we want to treat TV like a digital media and just know it. It's because we can make better decisions on investments within the business. So it's not that somebody's trying to compete, a digital marketing with TV and they're using the wrong equivalent. They're understanding the impact and return on that on various components of the business. So it's very important to bring attribution to the table and improve it, so somebody like Life can make a better decision whether today's equity percentage is better spent hiring an engineer or doing media for equity trade.
Okay, and then lastly, coming to you, Vinay, obviously you also speak to a lot of startups on a day-to-day basis. Are you kind of also hearing attribution, or do you think there is like any other kind of areas where media for equity really needs to make that big jump in order to really reach the mainstream much more?
Attribution is the elephant in the room, and there's also different philosophies on it, and that's a general marketing challenge we have. The issue is you can't really measure what's in people's heads, right? So what drives us to make a decision, a purchasing decision in the next month, 3 months, 6 months, 8 months? Is it the last advert they saw, or and ultimately there's plenty of evidence that shows that broad marketing channels which drive intent and give problem awareness over time dramatically change marketing performance across all channels. And so one of the things around attribution is who gets the credit. It takes a village to raise a child, right? So is it the last person who fed the child who gets 100% of the credit? And that is a massive philosophical debate. It's a rich debate, and actually I find no real alignment actually on this debate, except it does feel like there is truth in this idea that it takes a village to raise a child. I think in particular, you take I think me and Arjun were talking about a company last week, but let's take Tesla, right? Like Tesla, or next new EV company coming in, 50% cheaper than Tesla, out of China, big, it has to somehow tell you it is better than Tesla, or 50% cheaper, etc., etc. And how do you tell that message? And many companies will have a need to you won't be able to attribute your spend on billboards or radio necessarily, or podcasts, which it sounds like a nightmare. But generally that you do see there are studies, and many companies, you look at like rational companies which are digitally minded, and I've done quite a few studies of this. The companies that come on and spend on, you don't get these case studies because they keep the data to themselves. We just look at their average spend going up on traditional media channels, and they'll start off small and they start to grow up a lot. And what I've learned is that really sophisticated companies do all of the attribution in-house and have multiple models which are on net present value. And the important point is, if only 2% of people in the market at the time, and you're going for big media, then you have to attribute your big awareness media over a longer time period, and then your MPVs might start to make sense, because you might capture the other 98% or the 48% who, because maybe 50% are not interested in your product, right?
Okay, fantastic. Thanks very much. And thank you very much, everyone. We're over an hour now, so I think we're going to close. If we didn't get to your question, I'm very sorry. But thank you to all the panel for taking part. Vinay Solanki of Channel 4 Ventures, Arjun Kapoor from Forecast Labs, Nico Vesha from German Media Pool, and Leif Abraham from Public. And should also mention, if you're interested in this subject matter, this webinar was put on with help from the Global Consumer Council, of which Vinay is a member. If you want to get involved, the details are on the Global Venturing website. We do this every second Wednesday of the month, and next month is going to be strategic LP GP relationships. How do you create the win-win between your limited partners and your general partners? And that's on October the 9th. Forthcoming events, straight up next week, we have GCV Connect in the New Nordics. That's going to take in both Finland and Estonia, if you're a local company, or if you want to meet startups in that area, go ahead to that. And then we have the Executive Leadership Forum on October 24th in Silicon Valley, California. Corporate Venture Brazil is taking place the following week, the last week of October, in Sao Paulo. And then we have a GCV Connect event the exact same week in Frankfurt, Germany. GCV Asia Congress and International Delegation, that's taking place in Tokyo in November. And then possibly the big one for the year, or for the next year, the GCVI Summit in Monterey, California. I know quite a lot of you have been to that. And it's always great seeing you there. That's going to be March 18th to the 20th. And we also have CVC investment programs coming up. If you would like to kind of beef up your knowledge core, do some extra training, those got a few of those coming up. The next one is going to be September 24th and 25th, live online. And then we have 2 in-person ones toward the end of October, one in Silicon Valley, one in Frankfurt, 3rd in-person one in Tokyo in November, and then another live online one at the start of December. And then finally, we have Learning the Value of Corporate Venturing. That's a live program that's going to be taking place online between late September and early December. And then one more thing, if you haven't taken part in the annual CVC benchmarking survey, you mentioned at the top, but it's always great to get everyone's input. We really want a diverse kind of range of input on this to really get the real current state of what's happening in corporate venture capital right now. And if you take part, you also get a complimentary copy of the report at the end. So please go on the website and take part. And once again, thank you everyone for coming. And thank you to all the panel. Take care.